Welcome to Lesson 7 of Week 9. This lesson addresses program income, the revenue generated through activities funded by your grant. Many grant-funded activities generate income. Training programs may charge fees, clinical services may bill third parties, research may produce intellectual property, sales of products or publications may occur. When these revenues arise from grant-funded activities, federal regulations govern how they must be handled. This lesson will help you understand what constitutes program income, how federal regulations require program income to be used, different methods for handling program income, and reporting and documentation requirements. The primary reference is 2 CFR 200.307, which establishes program income requirements. As always, verify current regulatory text at ecfr.gov before making program income decisions. By the end of this lesson, you will understand how to identify, manage, and report program income in compliance with federal requirements. Understanding what constitutes program income is the foundation for proper management. The definition has specific elements that determine whether revenue qualifies. Program income is gross income earned by the recipient directly generated by a grant-supported activity or earned as a result of the federal award during the period of performance. The key elements are that the income is directly generated by or results from grant-supported activities and occurs during the award period. Timing matters for the definition. Income earned during the period of the award is program income. Income earned after the award ends generally is not, though some program-specific requirements may extend this period. The time when income is earned, not when it is received, typically determines whether it qualifies. Examples of program income include fees for services performed, such as training or clinical services, service charges for using grant-purchased equipment, sales of commodities or products, royalties from patents or copyrights, interest earned on grant funds where permitted. Various revenue streams can constitute program income depending on their connection to grant activities. The definition in 2 CFR 200.1 establishes the regulatory foundation. Your specific award terms may include additional guidance about what counts as program income for your particular program. Recognizing potential sources of program income helps you anticipate and manage these revenues appropriately. Various grant activities can generate income. Service fees are common program income sources. Training programs may charge registration fees. Clinical programs may bill insurance or participants. Conference and workshop fees generate revenue. When these fees arise from grant-supported activities, the revenue is typically program income. Sales revenue from products, publications, or materials created through grant activities constitutes program income. Manuals developed for training, products created through research, data, or materials provided to others for fees, all can generate program income if connected to grant-funded work. Equipment use fees arise when grant-purchased equipment is used by others for a fee. If your research lab allows outside users to access specialized equipment at a charge, those fees may be program income. The connection to grant-purchased resources triggers program income treatment. Intellectual property, including patents, copyrights, and licensing arrangements, can generate royalties that constitute program income. If research produces patentable inventions or copyrightable materials, revenue from licensing these products may be program income during the award period. Specific rules for intellectual property may vary by funder. Understanding what does not constitute program income helps you classify revenues correctly. Several categories of revenue typically fall outside the program income definition. Income earned after the award period ends is generally not program income. The definition specifies income earned during the period of performance. Once your award concludes, subsequent revenues from related activities typically are not subject to program income requirements, though program-specific terms may vary. Revenue from unrelated activities is not program income. If your organization earns fees from activities not connected to the grant, those revenues are not program income simply because you happen to have a federal award. The income must be directly generated by or result from grant-supported activities. Resources committed as cost-sharing are not program income. If a partner provides services as in-kind match, the value of those services is cost-sharing, not program income. The distinction is between resources contributed to the project and revenues earned from project activities. Specific exclusions listed in the regulations or award terms may apply. For example, certain license fees and royalties for patents and inventions may be excluded. Interest earned on advances of federal funds may have specific treatment. Review applicable regulations and award terms for specific exclusions. Federal regulations provide 3 methods for handling program income. Understanding these methods helps you apply the correct treatment to revenues your project generates. The deduction method subtracts program income from total allowable costs charged to the award. If your project has $1 million in allowable costs and generates $50,000 in program income, you would charge only $950,000 to the federal award. The income reduces the federal share of costs. The addition method adds program income to the funds committed to the project. The income supplements your federal funds, allowing you to accomplish more than the original award would support. If you generate program income, you have additional resources for project activities beyond your original budget. Cost-sharing treatment uses program income to meet cost-sharing requirements. Instead of reducing federal charges or supplementing the project, the income satisfies match obligations. This method is appropriate when your project has cost-sharing commitments that program income can help meet. The addition method is the default under the uniform guidance unless award terms specify otherwise. However, many federal programs have specific program income requirements that override this default. Always check your specific award terms to determine which method applies to your project. Award terms often contain specific program income requirements that you must follow. Understanding how to identify applicable requirements ensures proper treatment. Check your award terms carefully for program income provisions. The terms and conditions of your specific award may specify which program income method applies, require prior approval for generating program income, impose reporting requirements, or contain other provisions. Award terms control over default regulatory provisions. Different agencies may have different approaches to program income. NIH has specific policies. NSF has its own requirements. Education department programs may have distinct rules. The approach your federal sponsor takes may differ from the regulatory default or from other sponsors you work with. Specific programs may mandate particular treatment regardless of general agency policy. Some programs require the deduction method. Others may have unique requirements for how program income must be used. Program-specific guidance in the funding opportunity announcement or program regulations may apply. When you are uncertain about program income treatment, ask your program officer for clarification. Better to confirm the correct approach before generating and using program income than to discover later that you handled it incorrectly. Program officers can clarify how their program expects program income to be managed. How program income can be used is governed by the same requirements that apply to grant funds. Understanding these constraints ensures proper use of program income. Authorized purposes mean program income must be used for purposes authorized by the federal award. You cannot divert program income to unrelated activities or general organizational purposes. The income is tied to the grant and must support grant-related objectives. The same rules apply to program income as to federal grant funds. Cost principles governing allowability, allocability, and reasonableness apply equally. Procurement requirements apply when purchasing with program income. Documentation requirements are the same. Program income does not escape federal oversight simply because it originated as earned revenue. Timing considerations generally require dispersing program income before drawing additional federal funds under the addition method. This sequencing ensures program income is actually used and not accumulated while you continue drawing federal funds. Specific requirements may vary by funder. Restrictions on unallowable costs apply to program income just as they apply to grant funds. You cannot use program income for entertainment, alcohol, lobbying, or other unallowable costs. The limitations on how grant funds can be spent also limit how program income can be spent. Proper tracking of program income enables accurate reporting and demonstrates compliant management. Building good tracking practices prevents problems. Separate identification requires tracking program income distinctly from other organizational revenues. Your accounting system should clearly identify program income associated with specific federal awards. Commingling program income with general revenues makes compliance demonstration difficult and invites problems. Source documentation maintains records showing how program income was generated, what activities produced the income, what fees were charged, what sales occurred. Documentation should connect revenues to the grant-funded activities that generated them. This trail supports the characterization of revenues as program income. Expenditure records document how program income was used. Just as you document expenditure of grant funds, document expenditure of program income. What was purchased? For what purpose? How did the expenditure support grant objectives? Complete expenditure documentation demonstrates proper use. Regular reconciliation ensures income received matches expenditures and reports. Periodically verify that your records of program income received align with bank deposits and that expenditures of program income are properly recorded. Catching discrepancies early prevents reporting errors and potential compliance problems. Program income must be reported accurately in required financial reports. Understanding reporting requirements ensures you provide complete, correct information. Federal financial reports on the SF 425 include program income information. This form has specific lines for reporting program income earned and expended during the reporting period. Accurate completion requires good tracking systems and understanding of what to report. Reporting periods vary by award, but typically require reporting program income earned during each period. You report the income when earned, not necessarily when received. Understanding the reporting period and accrual versus cash basis issues helps you report correctly. Cumulative tracking maintains running totals of program income throughout the award. Each periodic report should reflect cumulative amounts as well as a current period activity. Maintaining accurate cumulative records prevents confusion and ensures consistency across reports. Final financial reports require accurate accounting of all program income generated during the entire award period. Discrepancies between interim and final reports require explanation. Complete, accurate final reporting closes out your program income obligations and demonstrates compliant management throughout the award. When subrecipients generate program income, additional considerations apply. Managing program income across sub-award relationships requires attention to flow down and reporting. Program income requirements flow to subrecipients through your sub-award agreements. The same rules that bind you regarding program income bind your subrecipients for income they generate from sub-award funded activities. Subrecipients must manage program income in compliance with federal requirements. Subaward terms should include program income provisions. Specify how subrecipients must track, use, and report program income. Identify which method applies. Require regular reporting of program income amounts. Clear subaward terms prevent confusion and establish expectations. Subrecipient reporting provides you the information you need to fulfill your own reporting requirements. Subrecipients should report their program income to you on a schedule that allows you to include it in your reports to the federal sponsor. Build reporting timelines that accommodate this consolidation. Combined reporting to the federal sponsor includes both your directly generated program income and amounts generated by subrecipients. Your federal financial reports reflect total program income for the award, not just what your organization directly generated. Accurate combined reporting requires good subrecipient reporting practices. Common program income issues create compliance problems that attention can prevent. Recognizing these problems helps you avoid them. Failure to identify revenues as program income is perhaps the most common issue. Organizations may not realize that fees, sales, or other revenues connected to grant activities constitute program income requiring specific treatment. If you do not recognize program income, you cannot manage it properly. Improper use of program income violates federal requirements. Using program income for unallowable costs, diverting it to unrelated purposes, or failing to use it according to the applicable method creates compliance problems. Program income is not unrestricted revenue, it carries obligations. Poor tracking produces inadequate records of income and expenditures. Without clear tracking, you cannot demonstrate where program income came from, how much was generated, or how it was used. Auditors examining program income need documentation you may not be able to provide if tracking is inadequate. Reporting errors on the FFR include inaccurate amounts, omitted program income, inconsistency between reports, and other mistakes. These errors may trigger questions from federal sponsors or findings in audits. Accurate reporting requires good underlying records and careful report preparation. Anticipating program income at the proposal stage prevents surprises and enables proper management. Thinking ahead about potential revenues produces better outcomes. At the proposal stage, identify potential program income sources your project may generate. If your training program will charge fees, if your research may produce licensable intellectual property, if your service program will bill third parties, note these possibilities. Some proposals require disclosure of anticipated program income. Budget implications of program income depend on which method applies. Under the deduction method, program income reduces your federal request. Under the addition method, it supplements available resources. Understanding the budget impact helps you plan your project finances appropriately. Planning for program income should occur before the award begins. Develop systems for tracking revenues connected to grant activities. Establish procedures for using program income in compliance with requirements. Prepare to report program income accurately. Good planning prevents scrambling when income actually occurs. Communication with your sponsor about program income expectations clarifies requirements. If significant program income is anticipated, discuss with your program officer how it should be handled. Understanding sponsor expectations before income is generated prevents misunderstandings later. Institutional resources can support proper program income management. Knowing where to find help ensures you handle program income correctly. Your sponsored programs office provides guidance on program income requirements. They can help you understand what constitutes program income, which method applies to your award, and how to handle specific situations. Consult them when program income questions arise. Finance and accounting offices maintain systems for tracking revenues and can help you establish appropriate tracking for program income. They ensure program income is properly recorded in institutional accounting systems and can assist with reconciliation and reporting. Technology transfer offices have expertise on intellectual property revenues. If your research produces patents, copyrights, or other licensable products, technology transfer staff understand how to manage resulting royalties and whether they constitute program income. Their expertise addresses this specialized revenue category. Training resources may be available through your institution on program income management. If you have not received training on this topic, ask whether educational opportunities exist. Understanding requirements is the foundation for compliance. Following best practices for program income management ensures compliance and prevents problems. These practices should guide your approach whenever your project generates revenue. Know your terms by understanding which program income method applies to your specific award. Check award terms, agency policies, and program requirements. The default addition method may not apply to your award. Knowing the correct method prevents using program income incorrectly. Track carefully by maintaining clear records of all program income. Document what revenues were generated, from what activities, when they occurred, and how they were used. Good tracking supports accurate reporting and demonstrates compliance if questioned. Use properly by ensuring program income is used only for purposes authorized by the award. Apply the same cost principles to program income expenditures as to grant fund expenditures. Do not treat program income as unrestricted revenue available for any purpose. Report accurately by providing complete, correct program income information on required reports. Include all program income, including amounts generated by sub-recipients. Verify figures before submission. Accurate reporting demonstrates responsible management and prevents questions or findings. Let us summarize the key points from this lesson on program income. Program income is gross income earned from activities supported by your federal award. Fees, sales, royalties, and other revenues connected to grant-funded activities may constitute program income requiring specific treatment under federal regulations. 3 methods exist for handling program income: deduction, addition, and cost-sharing treatment. The addition method is the regulatory default, but your specific award terms may require a different approach. Always check your award terms to determine which method applies before generating or using program income. Program income must be used for purposes authorized by the award and is subject to the same federal requirements as grant funds. Proper tracking and documentation demonstrate compliant management. Accurate reporting on federal financial reports is required throughout the award period. In our next lesson, we shift from managing revenues to preparing budgets for submission. Writing the budget justification is the art of explaining your numbers compellingly. A strong justification helps reviewers understand not just what you will spend, but why those expenditures are necessary and appropriate for achieving project objectives. Practice exercise. Consider a grant project you are working on or planning. Does it generate or could it generate program income? What sources might produce revenue? How would you track and report this program income?